Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. You know what really grinds my gears? Wall Street bets and their stonks that they love so much. Short squeeze. You know what stock I really don't like? And you know what food is too freaking expensive? Wendy's. That's right. So I have two fast food places in my teeny tiny little town. I have McDonald's, which is very affordable and delicious. And then I have Wendy's, which I don't know what happened recently, but their freaking prices are out of control. And that is my fundamental analysis of Wendy's. Therefore, I am not buying the stock because I drove up to it and I got in line and I got a meal for me and my wife. It was like $23. I was like, jeez, what's going on here? It's ridiculous. That's why I'm not buying Wendy's stock. But anyway, let's go through the fundamentals and I'm going to show you why this stock is overvalued trash. I think it's actually overvalued probably by 100%. It's freaking crazy, okay? Let's see. Market cap, $5 billion. That's right about where Tesla should be. I'm just kidding. Net income, blah, 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 blah. PE. So for an established restaurant chain like Wendy's, they have a freaking price to earnings ratio of $27 in this ridiculous market, or 27 in this ridiculous market. That's freaking crazy, okay? And then an average PE of 23 over the last 5 years. I mean, is Wendy's really going to grow that much more from here on out? I mean, Wendy's has been around freaking forever. Profit margin, not bad for a food place. I don't know if that's just been over the last year. And gross margin, 37%. Dividend, 1.1%. Here's what I don't like. So, return on invested capital, even during a fluke year where all these freaking businesses are just getting blowout revenues, which I don't think are sustainable, 7%. But over the last 5 years, including that fluke, 3.7%. That is a freaking garbage return on invested capital, okay? No, not a fan. Wendy's. Let's look at the income statement. So you're going to basically see that revenue since 2012 has been trending downwards. And it looks like they're basically doing a lot of dispositions. They're selling a lot of their business. They're buying a little bit and then they're selling. But as you can see, revenue in 2012 was $2.47 billion. And now it's down to $1.88 billion. So it's significantly decreased over the last 10 years. Net income, I mean, it's been profitable every year, but it's kind of been all over the place. They had $6 million of profit way back in the day, and now they have $185 million. You look over the past couple of years, $112 million the year prior, $474 million before that, $223 million. So it's just kind of freaking all over the place, okay? But the general trend is that I guess they're just trying to become leaner and meaner, and the revenue is decreasing. It's becoming a smaller company. Balance sheet, I don't really care about it too much. I mean, yeah, you can look at debt and stuff like that. I looked at the current ratio. It's like 2. That's fine. Cash flow. Cash flow from operations. Let's see. Over the last 5 years. So over the last 4 quarters, it was 389, and then it was 207, 217, 265. Here's the thing. So as you remember, this last year has been freaking crazy, okay? That's why I say almost discount the last year, because everybody got their freaking stimmy checks, money got pumped into the economy. All these different companies had massive spikes in revenue and earnings over the last year. But if you discount 2021 and you look at 2020, 2019, 2018, it's been going down. And then you just had this one blowout year. So if the stock price went up because Wendy's had this massive increase in operating cash flows, I think that's a mistake for a lot of investors. I mean, look at this. 265 million cash flows in 2018 from operations, down to 217 in 2019, down to 207 in 2020. So it's been going down. And then we had that one blowout year, and then it was 389 million. So not a fan. Free cash flow was also going down, and then we had this one blowout year, so that's also not an encouraging sign. This is a very interesting business. Now, you can actually see if they're selling parts of their business or if they're buying other companies to expand. And you want to look at acquisitions and dispositions under cash flows from investing. Now, when it's a positive number, like here, 5.9 million, that means they had a net cash inflow, which means they sold part of their business. So whenever you see a positive number, they sold part of their business over the last 4 quarters. Year prior, they sold part of the business. Looks like they made some acquisitions in 2019 and 2018, and then they sold a crap load of stuff in 2017 and 2016. So I don't know if they were jettisoning some like bad, components of their business, but they went on a freaking selling spree, a disposition spree in 2017 and 2016, probably to become leaner and meaner. But if you're curious about why revenue suddenly drops, I would instantly go and look at the statement of cash flows under investing and say, okay, is this because the company's dying, or is it because they jettisoned part of their business? So as you can see, they've been selling. They've been selling more than they've been buying or acquiring other businesses. Now, the 8 pillars. I don't really go off this because this could be just misleading. Like I've said before, this last year is crazy. I almost wouldn't count it for a lot of these companies. I would look at the trend for the last couple of years before the whole pandemic thing happened and kind of use that as a gauge. Because going forward, I don't know if that massive year is going to, all these companies are going to grow from that high point. I think there might be a lot of, drops in revenue depending on what happens with the economy. But better be safe than sorry. That's my opinion. So, stock analyzer tool. So I'll say this 1,000 times. You need to supplement this with Morningstar. Yes, the information pulls in from Morningstar. But if you have a sudden fluke year where revenue goes crazy, like it did over the 12 months ended June 2021, that can really skew your future assumptions. It's like, look at revenue for this. 1.88 billion over the last 4 quarters. Prior to that, 1.6 billion. So you look at that and you're like, oh, there's massive revenue growth. But if this is a fluke year, look prior. It went from 1.64 billion in 2019 to 1.67 billion in 2020. That's not that big. And then you had 1.41 billion to 1.64 billion. That could have been from an acquisition or a disposition. But that being said, you look at these averages and you're like, oh, wow, it's up 12%. That means it's going to keep going up 12%. It's freaking Wendy's, okay? Now, when you go to Morningstar, you can actually go to growth down here under key ratios, and you can look at revenue growth over the last, year to year to kind of get a rough idea of how it goes. Wendy's is kind of all over the place. It's, they sell a huge part of their business and their revenue drops significantly, or they make an acquisition and their revenue goes up significantly. What I did, because it's just so all over the place, and you want to be conservative if you're going to buy an individual stock, I went 3, 4, and 5% revenue growth, okay? Low assumption 3, high assumption 5. For Wendy's, that's pretty reasonable. Share buybacks, I said -1, -2, -3. It looks like they bought a bunch of shares back in the past, but they've been slowing that down over and over again. Profit margin. So here you have 10% over the last year, 13% over the last 5 years, and then 7.9% over the last 10 years. I went 7, 8, 9. Once again, if you go look, you can go to Morningstar and look at the recent profitability, because one crazy year can skew the results. So look back at 2011. I mean, they had 0.41, 0.28, 1.83, and then they increased their profit margins. But looking over the last couple of years, you can see they had an 8% profit margin in 2019, 6.8 in 2020, and then it's gone up over the last 12 months, which I think are a little nuts, to about 10%. So that's why you can't really factor in these one fluke years. You need to kind of see the recent trends of the company, which is why I use these lower, much lower profit margins, even than the averages, okay? But that's my personal opinion. I want to be very conservative. Free cash flow is a percentage of revenue. Let's go look at Morningstar. Cash flow. Free cash flow is a percent of sales. They call it revenue here. Revenue sales, same freaking thing, okay? So over the last couple of years, it looks like it's been going down. Oh, sorry, I was looking in the wrong place. Free cash flow is a percent of sales. So we have, going back in 2016, 2%, that might be an aberration. 13% in 2017, 9% in 2018, 12% in 2019, 12% in 2020, 18%. I would go somewhere in this range right here, between 9 and 12.5. So what I did is I went 9.5, 11, 12.5 because I don't want to use that fluke year and just overstate free cash flow in my assumptions as a percentage of revenue going forward. PE, way lower, 8, 10, 12. This is an established company, okay? This is not a massively growing company. Why would you pay such a premium for freaking Wendy's? Okay, it's kind of ridiculous. And of course, my desired annual return is 15% because I'm going to buy an individual stunk. I want 15%. I want to be compensated for my risk. So you do the analysis. In best case, the stock is a buy at $13.70 to get a 15% return. It's currently trading for 22%. Now, how would we make these assumptions better? I mean, I guess we could do like, if you just looked at this, you'd be like, oh, 10, 11, 12. And then you'd be like, for share buybacks, -2, -3, -4, profit margin. Let's go 10, 11, 12. 10, 11, 12. Free cash flow. Let's do 5, 10, 15. Let's do 15, 20, 25. 12, 15, 18. Now, if you did all that crap, oh, it's a screaming buy. You know, just by looking at this. Oh, revenue, 10, 11, 12. No, it's freaking Wendy's, okay? You need to be really conservative. And even then, with these really lofty projections, even then it's not really a buy, except for the high assumptions. So Wendy's needs 12% revenue growth over the next 5 years, buying back 4% of their shares with a 12% profit margin and a 25 PE to freaking make a profit or to have you get a 15% return. That's freaking ridiculous, okay? Freaking ridiculous. So no, I think the stock is freaking garbage. I think it's overvalued by almost 100%, and it needs to come down to earth before I even consider touching it. So if you see the clowns on Wall Street bets pumping this, just freaking ignore them. Garbage. Garbage. Anyway, I hope you learned something today. You always got to be careful doing these kind of analyses. You have to understand these different statements, okay? You can't just look at these percentages on the stock analyzer tool and just like plug in some numbers and boom. You actually have to see why these numbers are the way they are. It could have just been a fluke year. That's why you should go to your local library, and they probably have a Morningstar subscription, and then you can check a lot of these numbers for yourself to get really good, reasonable assumptions. Anyway, that's it. Like, subscribe, tell your friends about me, and you'll have a wonderful, delicious day. Cheers!